On October 31, 2011, the world watched as MF Global, once a titan of the derivatives market, filed for Chapter 11, marking the largest bankruptcy in U.S. history at that moment. In the span of a single day, more than $1.6 billion of client money vanished into a maze of risky bets, and the name Jon Corzine, former governor of New Jersey and former CEO of Goldman Sachs, became synonymous with financial hubris. This is the story of how a once respectable brokerage turned a gamble with customer funds into a catastrophe that still haunts the markets today. MF Global began as a modest futures brokerage in the 1970s, founded by the visionary Manuel "Manny" Cohen. Over 3 decades the firm grew, riding the wave of deregulation and the explosion of electronic trading. By the early 2000s, it had morphed into a global powerhouse, offering everything from commodities futures to complex credit default swaps. The company's aggressive expansion attracted investors, and in 2008 it merged with the then-failing Chicago-based Chicago Board of Trade, creating a behemoth with over $100 billion in assets under management. Jon Corzine entered the picture in 2008, stepping in as chief executive after a high-profile career at Goldman Sachs and a stint as New Jersey's governor. He promised to steer MF Global through the turmoil of the financial crisis, touting his experience and risk-adjusted strategies. Yet beneath the polished press releases, the firm's balance sheet was cracking. The 2008-2009 recession had slashed liquidity across the board, and MF Global's exposure to European sovereign debt, particularly the faltering Greek bonds, was growing unnoticed by many on the trading floor. By 2010, Corzine's leadership began to veer into a dangerous mix of optimism and desperation. He convinced the board to shift the firm's capital from low-risk client custodial accounts into a high-yield, high-risk repo-to-sell program. In this scheme, MF Global would borrow money from its own clients, pledge those funds as collateral, and then invest the cash in short-term European sovereign bonds. On paper, the strategy promised modest returns that could offset the firm's dwindling earnings. In reality, it turned the company's own customers into the lenders of a speculative gamble. The tipping point arrived in early 2011. European sovereign debt markets were roiling, and Greece's looming default threatened to plunge bond prices lower than anyone had anticipated. MF Global's repo positions were suddenly underwater, and the firm scrambled to raise cash. Corzine authorized a series of rapid, secretive transfers, more than $600 million in just a few weeks, moving client money into the firm's own trading accounts without proper disclosure. These moves were concealed from regulators, auditors, and, crucially, from the customers themselves. When the hidden transfers were finally uncovered in September 2011, the fallout was immediate. Regulators at the Commodity Futures Trading Commission, CFTC, and the Securities and Exchange Commission, SEC, launched investigations, and a wave of client complaints flooded the firm's hotline. On October 25, MF Global announced it could not meet its margin calls, and within days the company filed for bankruptcy protection. The filing revealed a staggering $1.6 billion shortfall, money that belonged to clients who had entrusted MF Global to safeguard their assets. The trial that followed became a litmus test for accountability in the financial sector. In 2013, federal prosecutors charged Corzine, former Chief Financial Officer Craig Miller, and several senior traders with securities fraud, obstruction of justice, and making false statements. The prosecution argued that Corzine had knowingly authorized the illegal commingling of client funds, effectively gambling with money that was not his to risk. Defense attorneys countered that the market's unprecedented volatility, coupled with a lack of clear regulatory guidance on customer segregation, had created a gray area in which decisions were made in good faith. In 2015, a federal jury reached a verdict that sent shockwaves through Wall Street. Corzine was acquitted of the most serious charges, criminal fraud and obstruction, citing insufficient evidence that he had personally directed the specific transfers. However, he was found liable in a civil suit for breaching fiduciary duties, resulting in a $5 million judgment against him and an order to pay restitution to affected clients. Several former MF Global executives, including Miller, were convicted on lesser counts and received prison sentences ranging from 12 months to 3 years. The aftermath of the collapse reshaped the entire derivatives landscape. The CFTC introduced stricter rules on customer segregation, mandating that firms keep client funds in separate, protected accounts and subjecting them to real-time reporting. The SEC pushed for greater transparency in repo-to-sell transactions, requiring detailed disclosures of any use of client assets for proprietary trading. Moreover, the MF Global debacle became a cautionary tale that spurred the adoption of the Dodd-Frank Act's Volcker Rule, which expressly prohibits banks from engaging in proprietary trading with depositor funds. For the clients, the human cost was profound. Thousands of small hedge funds, commodity producers, and individual investors watched their capital evaporate, forcing many to close operations or sell assets at fire sale prices. A class action settlement reached in 2017 eventually returned roughly $750 million to customers, about half of the missing funds, after years of litigation and complex asset recovery efforts. Beyond the financial repercussions, the MF Global saga left an indelible mark on corporate culture. It exposed how a charismatic leader, armed with a reputation built on past successes, could override internal controls and silence dissent. Whistleblowers within the firm reported that risk managers raised alarms as early as mid-2010, only to be dismissed as overly cautious by senior executives. Subscribe to The Verdict for more stories like this.